Welcome, everyone. My guest today is Taylor Stork, president of CHLA and the COO of Developers Mortgage Company, to talk about the challenges and opportunities facing IMBs in this market. Taylor, welcome back to the podcast.
Thank you. I'm glad to be here.
It's been a little bit. I mean, since you've been on the podcast, we talk a lot. And of course, you also send in op-eds, we keep in touch, but you haven't been on the podcast in a while.
No, I think that the last time you and I did this, we talked about the Consumer Bill of Rights that CHLA had put out, and maybe a couple of other topics.
I think that's true.
Yeah, we ended up on stage once or twice together. I think there might have been a flamingo dancing event somewhere.
Oh, yes, absolutely. I'm going to say yes to that one. We have a lot of things to talk about today, but I did want to start out with the fact that you are going to be one of our featured speakers at our IMB Summit, which is coming up really soon, October 1st here in Dallas. You're going to be talking with Paulina McGrath, which I'm super excited about that. Yeah. She's going to have that's going to be a great session. Yeah. And we have a lot of amazing people lined up there. We're excited to have you there. So that's the first thing. Everybody needs to come here, Taylor and Paulina, and just all the people that we have lined up.
Yeah, and listen, I got to tell you, I'm excited that I get to talk to Paulina. To be honest with you, she is such an amazing person. She is actually probably one of the reasons that CHLA has become kind of a bigger, more powerful organization than it had been once upon a time. She was formerly the chairperson of CHLA's previous kind of sister organization called CMLA. And candidly, she was part and parcel for how these two organizations came together. And so I've learned a ton from her. She's amazing. Not enough people know her. She's also somewhat demure, and she's going to probably want to beat me after she sees all this because she doesn't like to have the attention and be in the limelight. But I've learned so much from her. And I'll be honest with you, she's a little bit of the yin to my yang, right? So I, in fairness, am a little outspoken sometimes, and maybe a little maybe a little on the bold, provocative side. I don't know. And she serves a huge purpose for me to counterbalance. And when I'm not sure if I'm going too far on something, I'm like, Paulina, can you walk me off the ledge here? And she tells me when I need to slow down and take a breath.
Yeah, and so she's the vice president of the board of directors for CHLA. She's also the president of Republic State Mortgage, and we're thrilled about that. So everyone join us there, but let's also jump in here because we have had a lot of news this week that I'm just going to throw at you. So, starting earlier this week, you had ICE and you had a AI and technology conference that they co-hosted, and you had Rohit Chopra get up there, the CFPB director, and say that he was open to maybe getting rid of some mortgage regulations or whatever if it streamlined the refi process. And that really caught our attention. Would love to get your take on that. What did you think?
Yeah, so I was very excited about that statement. I'm also very curious about it because Director Chopra, if you don't know him, he's a very smart man. And very educated. He is also careful in his words. He's very careful. He's very thoughtful. And he does not say things by accident. So, and I've met with him personally. This is an individual to pay attention to. So when I saw that statement, I started thinking to myself, okay, what is within the purview of the CFPB? Because he's very focused on what their legal authority is to act, right? So remember, the CFPB it's functionally a policing agency, right? So they are responsible for ensuring that all financial institutions, from payday lenders to mortgage companies to banks to whoever, adhere to the rules. It was basically a consolidation of about 18 different agencies prior to the Great Recession. And so I know that there has probably been a lot of thought put into what is within the legal framework of the CFPB that they can do in order to impact the ability for consumers to refinance or whatever more easily. So I'm very curious the technicals behind where he's going with this.
Well, and here was the direct quote. He said, "We're exploring whether we should make certain changes to the existing mortgage regulations to streamline the process and to reduce closing costs. And when an existing or competing lender is seeking to refinance a mortgage with a much lower rate or a substantially similar quote, it may not be worthwhile for the lender to repeat many of the steps that were taken during the purchase process." And I think that is pointing to some of the things too that we know all the agencies have been focused on, which is technology, which is what's available to us now, which is, what can we do if do we need a new appraisal? Do we need an AVM on that? Do we need, the title, what happens there? So, and I agree with you. He's very careful. He's not going to say that if he doesn't have some real thought behind it.
There's an entire plan. It's just not ready for publication yet. And if you notice, there was also commentary by his deputy, Mark McCardle, right around the same time around some of the same topics. And I think when you put those two together, it starts to paint maybe a little bit of a picture of some things to come.
What does that mean for, CHLA and your lenders? I mean, do you guys have a lot of carve outs, for smaller lenders, or with CFPB, is it pretty much like you guys have to do everything the bigger lenders have to do?
We have to do everything the bigger lenders have to do, and sometimes more, to be honest with you. So there really aren't any carve-outs from the law. There are some carve-outs for organizations that are CDFIs. There's a little bit of more flexibility if you're a federal credit union and you're under $10 billion in assets. But IMBs, principally, I would argue that we are the most regulated of the institutions. I know that there are people that will say that I'm crazy for saying that, but we don't have federal preemption under the National Banking Act of 1863 or 4, back to the Civil War, which established federal preemption for banks. IMBs don't have a prudential regulator. That is a fair statement. But we have 50 regulators, depending on how many states we're in. Plus we have HUD and CFPB and all the kind of pseudo regulators that have significant oversight as well. So, the fundamental issue is that IMBs have to play by the CFPB rules and also 50 other sets of rules and hope that all of them line up together, which is actually one of the concerns you're going to ask me about in a second when you ask me about the servicing thing.
It's true. But before we do that, so I was at the tech sprint for this FHFA, and, everybody presented their use case for AI in financial services. And then you had this panel of judges, and it came up over and over again. The judges were like, "That's a great idea. That's innovative. That's great. How are you going to reconcile that with federal and state regulations that don't agree on what the law is on this particular thing?" Like, the judges were like, "This is a great idea. If you're just doing federal, great. If you're just doing state, great. If you're doing federal and state or multiple states, how is this idea going to come?" And it just really underlined to me that, like, there's so many challenges here when you have 50 different regulators.
Yeah. So there's a complex issue, right? Because in order to really experience economies of scale, any mortgage company needs to grow and diversify across different geographic regions. If you don't diversify and kind of spread your business out, then you are exposed to a very unique kind of risk that is, if you're in one city or one state, you could have a problem. You want to diversify, but the more you diversify, the more risk you add by having potentially conflicting regulations and conflicting sets of not just regulation, but also kind of operating structure. And it gets complicated. I operate in New York, I operate in Texas, I operate in South Carolina. There's different rules in those three states, and they don't agree with each other.
Yeah. From your perspective, because we do know that compliance thing, it can be such a burden on IMBs. Do you feel like, so when I started at HousingWire, it was 2013, we were under a different administration.
You were 12.
Then, oh yeah. Yes, I was. No. And then then we had the Trump administration, we've had the Biden administration. From your perspective, like, how much Is it a really big change anytime you have an administration come in as far as the regulation, as far as like, are you like, woohoo, if there's a different administration, or are you like, there's so many things that are just like baked in already, it doesn't really matter?
Wow, that's a big, huge, gigantic question.
It is. It
So,
is.
Sarah, you know me well enough to know that I work very hard to stay apolitical publicly, and I work very hard not to endorse one side or the other of any policy. And I do that for a lot of different reasons. I believe that housing supersedes politics. I think every single person in this country needs a place that's safe to sleep at night. And I believe that every one of them should have an opportunity to pursue ownership of that home, and start building wealth. So I'm really careful when it comes to conversations about political change and how different administrations act. All administrations are concerned about housing because
Right.
all people need a home for their kids and their families and a place to sleep. I do see that they often come at it from different angles, and maybe that's good and maybe that's not good. When there is administrative change, the bigger issue from my perspective is not so much about kind of theoretical and policy direction change. It's about people change, right? Because when people change, often relationships change, structure changes. We often see groups of thought, like high level knowledge workers, exit as a result of administrative change. And we just saw that together. You and I were in Dallas, right? I didn't make it to the FinTech because I was busy attending a HousingWire event. I'm not sure how you pulled that off. And there was a presentation given by the director of AI research for the Department of HUD. And during his presentation, he mentioned, oh, by the way, I'm not going to be here for much longer. I'm leaving HUD to go to a different sector. And when I asked him later, I said, why? He said, well, because there's going to be an election.
Yep. And I think that's really, so first of all, kudos to you for staying apolitical. And I do think, I mean, we do the same thing. We're like, we're worried about housing.
Yeah.
What is going on with housing and the people who work in housing? And to your point, I mean, there are some things that are baked in that aren't going to change. And then we'll let Bob Brooksmith, so he's coming to IMB, and he's going to do what the election, what impact the election can have. We'll let him do that. What do you think?
Okay. I think that's great. I love to hear Bob speak. He's fun. He has a great personality, and he really does understand politics as it relates to the mortgage business. Credit where credit is due. He understands the games that go on in Washington, D.C. And that's a difficult thing unto itself. It's not easy.
It's not easy, but I do appreciate exactly what you said there, because I think that's it. And I think that, we see Chopra's remarks here about looking at closing costs. I feel like that has been for the last 2 or 3 years something that's really been a place that this administration feels like they can make a difference, because it's so hard to do national housing policy changes that make a difference to the bottom line for you guys, for consumers, because it's not really based on that, right? So what they can do is attack closing costs in different ways, and we've seen them do that.
Yeah, and don't forget, I think we often overlook that there are laws in this country that go back 50 and 60 years that all agencies have to operate through, right? Whether it's the Fair Housing Act or the Equal Credit Opportunity Act, or whether it's the CRA and then subsequently Dodd-Frank. But all of the different things that any director of any agency proposes to do, it's all going to be contained in what they are legally able to do. Because if they don't follow the law, they run the risk that 6 months, a year, 2 years down the line, Congress is going to change it, or a lawsuit is going to result in everything for the last 2 years having been unwound, right? And we saw that take place with Chevron. We saw that take place with the question over CFPB funding through a line item of the Treasury budget. We saw that with the Supreme Court case about whether or not the director himself or herself acted at the will of the president. So they have to focus in on what's specifically legal within the box.
It's true. I mean, they have they have to do that, and so some things don't change. I did want to circle back and also ask you about another thing with the CFPB, which is around their revisions to the Regulation X proposal. Right? They did that in July. The CHLA sent them a letter, I think this week, and you were really urging them to balance the time frame and processes for the loss mitigation changes they were making there. So, maybe we can talk about that, like from your perspective, why is that a really important topic to your members?
Okay, so it's a great question, and it gets a little bit in the weeds and complicated. So first things first, in the proposed Reg X, their rules, there are a couple of different carve outs, right? So there's a carve out if you're exempt if you're under like 100 loans, I think, under servicing. Then there's a couple of others. First and foremost, the overwhelming majority of IMBs are operating under existing servicing rules that are issued by Fannie Mae, Freddie Mac, Department of HUD, so FHA, Ginnie Mae, everybody. So you got to remember that over 90% of loans that are manufactured are somehow find their way into the realm of either HUD or FHFA, right? Which is kind of the two big regulators. And there are already robust rules in place. I think what the CFPB is really attempting to do is shore up the cracks where loans fall through the cracks because they're not covered under those robust sets of rules. But in addition to those the robust sets of rules, as you mentioned earlier, there's 50 states plus the District of Columbia plus Puerto Rico, right? So, I mean, you have to get licensed to originate loans in the U.S. Virgin Islands. So, wow. So there are each of the individual municipalities, states, they also have their own sets of rules. Anybody that operates in the state of New York, the rules to service a loan in the state of New York are extraordinarily robust. So back to one of the original things you said, and this is my concern for IMBs, when you layer in new sets of rules and they don't match up and kind of mirror the existing structure through other existing sets of rules, whether through HUD or FHA or FHFA or one of the GSEs, when they don't mirror up, now you create the scenario where it's not just loans that are falling through the cracks, you're creating cracks in the system. Our big concern is not so much about the scenarios where the loans would have already been covered by the general existing structure. Our concern is when there are conflicts in the rules and when one set of rules might undermine another, right? And that's where it gets very confusing for an IMB. It gets incredibly difficult for an IMB to navigate through when you're trying to figure out which set of rules you're supposed to follow.
Right.
Hard. Hard is expensive. And what expensive
that's what I was going to say.
Expensive devalues loans, right? The more expensive it gets, the less valuable a loan is. And that devaluation of loans flows through to the value of an MSR, which flows through to the rate sheet, which flows through to the consumer. So the more regulation, and I support regulation, but when it's conflicting, it ultimately results in higher prices for borrowers. And that's our big concern.
Absolutely. No. And I think that goes back to our excitement to hear Chopra saying something about like, maybe we need less regulations on, in different ways, because I mean, it's definitely, some of those are on the cost. So let me ask you, since you were at our AI Summit and since we've been talking about technology and all of the things it can do, when you look at this, what are you excited about technology-wise for your IMBs?
Wow, that's a great question. Technology is making huge leaps and bounds in the mortgage space. And there's good news and then there's also some scary news, right? So technology was largely stagnant after the Great Recession. We watched investment in technology run away from mortgage because we ran away from mortgage in general. Mortgage was a scary place from 2008 to 2000 and whenever. We really didn't see technology become exciting in mortgage until, 5-6 years ago. It started getting really interesting. And then there was this boom. All of a sudden, there were 20 different LOSs and new POSs, and integrations, and people learned what APIs were and consumer permission data. And what excites me about technology is that I'm starting to see these disjointed technologies begin to coalesce, right? So credit where credit's due. FHFA has been driving a lot of this through Fannie Mae and Freddie Mac. I attended the tech sprint the year before last. You attended the tech sprint this last year. And what I've seen is a very distinct focus at the very highest level. I mean, let's be honest. A lot of what drives mortgage and how we all respond is what our largest investors are going to buy from us, right? And our largest investors at the end of the day are Fannie Mae, Freddie Mac, and sometimes HUD. I shouldn't say
Right.
Ginnie Mae. So FHFA had put a lot of focus in the last couple of years into emerging tech and then finding ways to support that emerging tech in the IMB space. The challenge for IMBs, and I was actually just on a separate call earlier talking about this. The challenge for IMBs is, on the one hand, we need to be tech forward. We need to have robust sets of tools for our customers and to operate our businesses, right? So we need to be creative. We need to have uniqueness. We need to have competitive advantage. And all of that in today's modern world is, not all, but most of it is driven through technology enhancements. But the flip side of that is we're a bunch of mortgage people and finance people. We're not coders. I'm not the guy that stayed in the basement, building video games on my phone. And so there's this unique scenario where a lot of the knowledge workers in IMB space, and I believe in, credit unions and banks, we're not generally super tech forward, but we're excited about tech. So it's really great to see that FHFA, and specifically Fannie Mae and Freddie Mac, are driving forward a lot of technology enhancements that we can more easily adopt, specifically consumer permissioned data, right? So bank statements and pay stubs and automated VOEs and all this consumer permissioned data that removes friction in the process and helps us get access to information earlier, and also enables us to ensure that the data we're receiving is accurate and is legitimate. Like, the adoption of consumer permission data models, it is so important for our business. And the more we can enhance that, the more we can get added into it, the better a customer experience is going to feel like, and the more accurate the manufacturing of our loans is going to be. So really, what I would say that I'm most excited about isn't one single piece of tech. It's about reducing the friction that inherently lies between third-party providers, LOSs, POSs, and then kind of the big box of the ultimate investors that buy it all from us.
No, that's great. I think there's so much opportunity there. And of course, the goal would be, if you're an IMB, like, it should level the playing field a little bit, right? Like, if we can get over the hump of, like, how do we get through this? I think it's a pretty messy period where you have legacy technology, you have AI, I think things are going to shake out a little bit, right? We're already seeing that in some places, but it's like, on the other side of that, the promise of technology for IMBs is that it can level the playing field. They can scale, they can do things more efficiently. They can, do what they really want to do, which, to your point, is like, selling is getting people in houses. It is not, it's selling loans. It's not about technology. So
yeah, no,
I think that's great.
Right. And there are a lot of people who are really dedicated to this business because they're dedicated to what this business does, right? So that is, I want to put people in homes. I want to make sure people have a safe place to sleep. I want to make sure that people are building equity in their own right, instead of, building equity for somebody else. And so there's an intrinsic value to this for many, and I'd argue most people in our business. And the technology done right, the technology reduces friction. Reducing friction reduces cost, no matter how you slice it. So it reduces friction, which is better for the consumer. And the more we can reduce friction, the better we can provide for the consumer. The more options and choices they have, the better experience everyone has. I'm a big believer in having lots of options, lots of competition, lots of choices, because all that competition drives us to be better as an industry in general. And that's what propels housing forward and makes it the American dream.
Man, that's good. That's really good, Taylor. I feel like standing up and clapping, but it's really true. That is when I talk to so many people in this industry, it's what keeps them here. There are other things you can do that are a lot easier. Let's be honest.
Yeah.
I mean, but that's the drive. I so appreciate you being on. I did want to mention Anne-Marie Pippin from the FHFA will be at our IMB Summit, so I'm excited about that. And I just wanted to say thanks because I feel like you've really partnered with us for this summit to say, what is it that IMBs are really interested in? Where are the opportunities? Where are the challenges? Let's develop things around that and speak directly to that. So thank you for that. I can't wait to see you on stage. And thanks for being here today.
Thank you for having me. I am excited. Look, I love doing things with HousingWire. You guys are fresh. You're forward looking. You're fun. I would tell anybody who's trying to think about whether or not they're going to make it out to Dallas, get out to Dallas. I'm personally inviting people. Come out, join us. We'll have some fun. We'll talk about stuff.
We are going to have so much fun. It's going to be amazing. We do a good job on events, you got to say. So we're always going to have fun.
Yeah. Thank you for having me. I'm super excited about it.
Thanks, Taylor.